and introduce Jonathan here as the regional manager of wealth management, I guess, for Canada Life. Jonathan has several years of experience in the investment management world and has been brought in on a number of cases to consult with me. So I asked him to join me today to do a bit of an overview of some basic investing principles and talk a little bit about some of the things that have happened in the markets in the last year or so, and what we might be able to expect for the next couple of years as we go into and come out of, hopefully, a recession that all the economists are telling us to expect in 2023. So without further ado, I will turn that over to Jonathan, and if you want, I'm going to go ahead and stop my video to save on bandwidth, and we'll let Jonathan take the floor. Take it away.
Thank you, Lauren. Does everyone see my screen? Just thumbs up if you see the screen. Yep. Sylvie, yes?
Yes.
Okay, perfect. Thank you. Okay, so my name is Jonathan Polcari. As Lauren mentioned, I'm a regional manager with Canada Life. I cover everything from Belleville all the way to Cornwall. So I guess you would call that Ontario East. That being said, I have two designations. One is Chartered Investment Manager. Chartered Investment Manager has to do with the investment side of things, talking about the investments themselves. And I'm also a certified financial planner, which has to do with more of the planning side, meaning, if you got certain goals, how to help you work through those goals. It's not just investments, it's everything that surrounds that. So well-versed in that area. So I will share this full screen here. If you have any questions at any point, just let me know. My talk today is to talk basically about making sense of investments, but making sense of investments in your terms, just to understand it broadly and how it would fit best for you. So let me just move this out of the way here. I'll put this here. Okay. Yeah. All right. So I've got really four things I want to talk to you about today. One is what types of investments you can and should use depending on your situation. The other thing is something which we call a cash flow funnel. It has to do with when I'm invested, where do I take the money out of? If I'm going into retirement and I need a certain amount of money, or if I want to set aside money for a cottage or vacation, whatever it may be, where do I take the money from? That's what the cash flow funnel talks about. The two last points have to do with more of the markets today. One is how to navigate through tough times, and the other one's, it might sound a little bit weird, but bonds had a really bad year last year. Most of them lost between 10 and 15%. So now it's just to understand, historically, when we've had high inflation, what to expect after we've had a bad year in bonds. Okay, so the first thing is, a lot of people talk about investments. They talk about stocks and bonds and all these types of investment vehicles, but it's very seldom that we'll talk about what are reasonable expectations. If I make 2% a year, if I make 20% a year, if I make 30%, what is the reasonable expectations? What should I expect my investments to return me? And what have they done in the past? And what can we expect from them in the future? Okay. So I know this is a little bit of a busy slide, but I will expand on it here and take my time to explain it to you. So the first thing is really there's a few categories. Now, this is taken from FP Canada. FP Canada is the Financial Planning Council of Canada. That's the the body that I'm represented from. I'm once again chartered financial planner, and FP Canada is the one that sets the rules and sets the guidelines. There's all kinds of projections out there, but what they do is they have a council of people that have looked at the past, looking into the next couple of years and what can be expected going forward. So really there's, like I said, 4 main categories to look into. One is going to be short term. Short term has everything to do with cash. Can be anything from a savings account at your bank to what they call a money market fund. Really, this is something you could put in your money and take it out, either at any time or in a short period of time. So that's why I also included GICs in there. GICs, there are GICs that are less, that are a year. So I wouldn't consider GICs that are longer than a year to be a cash instrument, because obviously they're locked in for more than a year. The second part is bonds. Bonds are, if you don't know, companies or governments borrow money. You lend your money to either a company or a government, and they'll pay you an interest rate based on that. Okay, those are generally a little bit more safer. You give a certain amount of money at the beginning. Let's say if you have a 5-year bond, for example, you give your money to the government of Canada. They return you a certain amount during that 5 years, and then they give you your money back at the end of the 5 years. Lastly, we've got 2 pairs of stocks. One is Canadian stocks, everything that has to do with companies that are listed here in Canada. And then I've grouped the last part, which is global. Global, will it include stocks from the US or everywhere else around the planet? So just going back, we take a look at short term. Short term, you could expect the projected, for example, if we were going to do a financial plan for you. Sorry, I see Sylvie, but I see maybe that's your husband with you. What's your husband's name?
Rock.
Rock. So Sylvie and Rock. Obviously, the short-term instruments, what we're looking at is if we're doing a financial plan, these are the numbers that are reasonable to use to see if we can meet your goals, right? Because you can say something's going to do 20%, doesn't mean it's going to happen, right? So firstly, the short-term instruments, you look at 2.3%, bonds 2.8%, so just under 3%. And then Canadian stocks, we're looking at above around 6.3, and globally a little bit more at 6.6. I added this last category here, this balanced portfolio. A balanced portfolio here, it's funny because a balanced portfolio in our industry can be anything between 50% stocks to 50% bonds, and then they'll go a little bit more one side or the other. So it's more broad, but for a very simple explanation, in this case, the 50-50 is going to be, the balanced is going to be 50% in bonds and 50% in stocks, and you can expect about 4.8%. Most people are invested into something like this, okay? Now, just to kind of look, these projections going forwards, are they reasonable? Well, yes. If you take a look, I took the last 25 years over here, and I said, does it match close to what we've seen? Well, you see that cash has returned about 2.2 versus that 2.3. We're pretty good there. Bonds have returned more, but that's because, we've had about 30 years of very good returns in bonds. But going forward, I think we'll have a very good year this year and next year into bonds, and I'll explain why a little bit later. But 5.2 was a little bit high. I think we're probably going to be in between there. So 2.8 might be a little bit low, but at least it's a conservative projection. Canadian stocks over the last 25 years have done just under 8%, and global stocks have done under 10. And then once again, a balanced portfolio around 7%. So as you can see, just because we say 4.8 doesn't mean that it's a very strict number. It's going to be 4.8. It can be, around there. But that's, as you can see, we can't keep more of a conservative projection when we look at it. The other thing that I want to show you, because it's going to be important to the conversation we're going to talk about in just a second here. Let me just erase the rest of this, make this clean here. Okay, so what I did is give you the worst case scenarios. Okay, so it's fine and dandy to say that Canadian stocks have done 7.9% over the last 25 years, but what happens if I can only be in Canadian stocks for 3 years or 5 years? So this is not the average. This is the very worst case scenario. Okay, this is the disaster scenario. So what you can see is even in the worst case, cash has never lost money, which makes sense. Cash is cash. It doesn't lose money. You can talk about inflation, fine, but it doesn't lose money. And you can see whether it's 3 years or 5 years, cash has never really lost money. When you take a look at bonds, well, even bonds, which are pretty safe, if you've only got 3 years to invest, there has been a scenario where bonds have lost money. But 5 years or more, if you've got at least 5 years, bonds will do fine. Stocks, you see here, stocks, if you've only got 3 years or you've only got 5 years, doesn't mean you're going to lose money, but there is a risk of losing money, which means if you take a look, if you have at least 10 years, it's a great investment. Okay. Okay. And then lastly is the global stocks. They're a little bit more volatile. The worst case scenario is even over 10 years, some have lost money. Generally, they don't, but some have lost money. So you take a look here, and logically, if I take a look at it, and I'm saying, all right, I want to retire, or in 5 years, I need to have some money. Well, what's the thing where I'm going to make the most money? Is probably going to be a balanced fund. If I've only got 3 years or under, we're looking at cash. But it doesn't mean you have to put all your money in one basket. So that's what I'm going to go over in a second here. Now, there's a lot of information on this screen. I want to make sure does this make sense to you, Rock and Sylvia? Yeah. Perfect. Okay. So here's the nice part about it. We take that projection. You know, percentages are percentages, but I find that generally they don't give you a good understanding of the power of compounding, right? Einstein said man's greatest invention is compound interest. There's a reason for that. So even at a modest, just under 5%, here's what I'm showing you. I take $200,000, okay? I don't invest any more money. I just leave the $200,000 as it is. And I just show you with a 4.8% return what it looks like after 10 years and 20 years and 30 years, okay? So as you can see, it starts off after 10 years, you made 50%, just over 50%. Then after that, after 20 years, it's more than double. And then after 30 years, you can see we're making 4 times our money, 5 times after 5 years, and then 10 times after, what is that? After 50 years. Now, 50 years is a long time, but I just wanted to show you what the power of compounding is that your 200,000 will grow quite substantially. And if somebody were to tell you that if you hear a commercial telling you invest 200,000 and you'll have 2 million, well, it's possible. It's just not possible in some of the time frames people are promising sometimes. But more importantly, what I wanted to show is, sorry about that. I'm just trying to get this here. What I wanted to show is how much income can you draw from your money, your initial 200,000. If I've got 30 years of income that I need, how long is it going to last me? Okay. Or rather, not how long is it going to last me, but how much can I take out and expect that the money won't run out. So you see, with 200,000, I could basically take out 12,700 a year, and that'll last me 30 years. Okay. And I say 30 years because that's a typical retirement times period. Well, after 10 years, I can take out 20,000. And after 20 years with my 500,000, I'll have 32,000. So what I wanted to show with this is just, if we do proper planning, we can show you, depending on what your risk is and how much money you have to initially invest and how much money you have to put aside, we can tell you what your income will be in retirement with a good degree of certainty. Nothing's ever guaranteed, of course, but with a good degree of certainty based on averages, you can get a really good idea of what were your retirement or other things. It doesn't necessarily need to be retirement, but this gives you a really good idea of what to expect and how much money you can draw from your savings. I just want to pause here for a second. Any questions from Rock and Sylvia? And I see Sandra has also joined us. Okay.
We're good.
Perfect. Thank you. Okay, so I've shown you a couple things. I've shown you past returns. I've shown you timelines, historical timelines. The last part really is your risk tolerance. And risk tolerance, what it means is how comfortable are you taking certain risks, okay? Personally, I believe that when you take a look at it in the context of, if I've got at least 10 years for this chunk of money, I can take a certain amount of risk. You might want to take a little bit less risk than that, but given on historical facts and seeing that the worst case scenario is 1 or 2%, if, for example, if you're in stocks and the worst case scenario over 10 years is about 1%, well, the average is around, like I said, 6 or 7%. So you're probably going to land up on the average. You might be higher, you might be lower, but if you have the worst case scenario, at least that gives you a certain amount of risk you can take. So using these three things, right, we can construct the ideal portfolio for you. So when we construct the ideal portfolio, what we need to do is to understand what your income needs are. Is it retirement? Is it a home purchase? Is it a rainy day fund that you need to keep? So all these different things, right, have different, you can invest, you'll have to invest them with different type of portfolios, either something more conservative or more aggressive. The second part about it is we understand the ability for the client to take on reasonable risk. Once again, it's good to say, yeah, you should be super aggressive, but if you're not able to stomach the up and downs, even if you know that at the end of the day you'll make more money, that's a conversation that advisors and financial planners have to have with their clients in order to make sure that that's the case. And then once we take that, we construct, I mentioned it before, but this cash flow funnel. And what we do is we match your needs, your income needs, to the type of investments, right? It's not the other way around. We don't say, well, if you have a balanced portfolio, you can make X amount and you can take out this much. No, we'll do the opposite way. We say, what do you need? And what's the maximum amount of risk that we can take based on what you need? We don't want to go over the amount of risk, right? Don't need to take unnecessary risks. Okay, so a cash flow funnel is basically how to optimize your portfolio based on your needs. So we have certain terminology in the financial services industry where I told you about stocks and bonds and cash and all that. But basically, after that, we put them in different type of portfolio. So, for example, a balanced portfolio generally means that you'll have 60% in stocks and 40% in bonds, and then everything across. So, maybe I'll throw it out to the audience, and Lauren, you can answer this as well. If I say that you've got a balanced portfolio, 60 and 40, and I say that the minimum holding period is 5 years, what does that mean to you, minimum holding period? Not all at once, please.
It means you can't touch your money for 5 years.
Okay, that's good. And does that mean all of your money? Does it mean a portion of your money?
Well, I mean, you could probably withdraw some if you needed it, but if you really want to make the maximum on that money, 5 years is the best time to leave it there.
That's right. That's very good, Sylvia. That's a good way of thinking about it. And by the way, it's not that anything is locked in because of the investments you put it into. It's just if you want to maximize and make it work to your advantage, that's the amount of time. So one of the things, when I put this slide up, a lot of people say, well, I'm retiring in 5 years, or I'm retiring in 2 years, I need to go conservative. Well, no, you need a certain amount of money in 2 years. You might need only 10% of your portfolio in 2 years. So, even at retirement, think about it. How much of your money are you going to need 10 years from now? A good portion of it. So that's the important part, is not just sticking you in a cookie cutter, 2 years conservative, it's done. It's more about layering it and saying, well, a certain portion needs to go into this and a certain portion needs to go into that. And that's why I like to bring it up with end clients, because it makes it easier for you to understand. If you've got, we went to last year and a lot of markets were down 10 to 15%. Okay. Now, if you know that, let's say you have a $500,000 portfolio and next year you need 50,000. Well, if your portfolio is down, but the 50,000 was set aside in cash, well, you're not as worried about the rest of your portfolio because you know that it has time to recover, right? You've set aside money that you have time to recover, right? So that's what we call the cash flow funnel. So I'll move on here just to show you what the cash flow funnel looks like. Basically what we do, and this can be with a RIF, this can be with an RSP, this can be with any type of money. It doesn't matter what account you hold it in. But what we do is we start off, let me see if I can just move this here. Sorry, guys. So you see here, it says payment to client. Okay, so in my example, I talked about 50K, right? So if there's a payment 50K that comes to the client, well, what happens is, well, I got to take 50K from here and move it down, and then move it down, and then move it down. So you see, like, basically you start off with 50,000 in a cash instrument. Then you pay that to the client. So next year, what do we have to do is we take our second most conservative, which is our conservative portfolio. We take 50,000 from that. Sorry if it's red on red here. And then we put it back in here. So the point is, even if the market is down, a lot of people will panic and say, well, I lost money. I'm going to take all of my investments and put into something more conservative. I'll put it into cash. And that's where a lot of people's retirements, you won't have the 30 years. You might bring it down to 15 years. A lot of that happened during 2008. It was very, very difficult for a lot of people that were in retirement or that needed money. But the point is, if you've got a $500,000 portfolio, it's down to, God forbid, 400,000. Well, you set 50K aside in cash. Well, if I need to take money out at the market low, let's say you're very unlucky and it's the market low, well, at least I'll take it out. I've only taken out a certain portion of my portfolio, not the entire amount, and not made that mistake of really reducing the amount of time that I've got money for my retirement. Okay. And once again, I say retirement just because it's the easiest example, but I'm sure you have many other things you can think of that you need cash flow for. Okay. And here's the other thing. If the stock market is down 20, 25%, your conservative portfolio, if we've done things right, by the time the 2 years is up, that portion of money shouldn't have lost anything either, right? So although your overall portfolio is down, the chunk of money that you're going to take income from won't have lost money. Okay. So obviously your portfolio will evolve over time. You'll probably, when you're starting your retirement, have 60, 70% in stocks, maybe. By the time you're closer to the end of retirement, you might have only 10 or 20% in stocks, right? So it evolves with you. It's not just, once again, a cookie cutter type of formula. Any questions on this?
No.
Perfect. Does this make sense to you? Have you seen something like this before?
Yes.
Perfect. Okay, so here comes the a little bit of a tougher conversation. It's great to have a plan, and it's great to stick to it, and it's great to have an advisor to kind of remind you of that plan when things go sideways. But here's what history shows us about going through markets in downturns or tough times. Okay. Sorry, we're just gonna move this here. Keep on moving you guys around. Where am I gonna put you here? Okay. So here's an example. So we took the S&P 500. For those of you who don't know, the S&P 500 is the U.S. stock market, right? It's just a representation of most of the companies, or most of the big companies anyways, in the U.S. So for those of you who were investing back then, you will have known that the stock market took a real hit, a real dive between 2007 and 2009, into March 2009. So in this example, we're starting with $10,000. Let's see if I can make this bigger. Yeah, okay. So we're starting with $10,000, and you see that the market will have gone down to basically 40%. So your initial $10,000 that you put in is down to 5,826. A lot of people did this, by the way, what I'm about to explain. A lot of people said, you know what, for example, Lauren, take me out. I can't take the risk anymore. It's just going to cash. I don't want to lose anymore. Usually when people reflect on that, that's usually when the market bottom comes, but I digress. That's another story. But here, this chart shows, this chart shows three options. One is you put the money in GICs. Two is you kept the money where it was. And three is you doubled up. Now, doubling up, I think, just exacerbates it a little bit, shows you how advantageous it is to, invest at the market bottom, but timing the market bottom is very, very difficult. Okay, so we'll just get rid of this for now. But here's the point. If you were to take that 5,826, you're going from March 2009 to December 2015. That's about 6.5 years. This was based on the rates back then, but your 5,000 goes up to 6,006. So you've recovered maybe 10 to 15% of it after 6 years. Okay. Even at today's rates, I took a rate, sorry, I don't know if you see it or not, but I took a rate of 4.55 when I constructed these. These were some of the GIC rates. Even at this high rate, and assuming that you can keep that high rate, you're looking at a 7,500 after 6 years. So you have not recovered the initial loss. Obviously, smaller losses, it'll take you less time to regain it, but you could see some of the trouble that people have had and how the retirement has got pushed back because of it, okay? If you would have just left it as it was, 6 years later, we're looking at not only recovering the money, but 70 or 70% up on your initial amount. And if I take a look here, you've probably recovered after, I think it was after 4 years or something, 3 or 4 years. And this is one of the worst case scenarios we've seen, in a long time. Unfortunately, we had two really bad ones in the 2000s. From 2001 to 2003, and end of 2007 to 2009, March 2009. Those were two really big ones, 2 in a row. But even in that case, it was advantageous to stay put. So that's why, going back to the whole cash wedge strategy or cash flow funnel, it allows you the peace of mind to know that, okay, I've got some other money set aside and we've planned for it, right? So it allows you to stay invested at the proper time. Once again, this is a little bit of a busy chart as well, but this is every market decline, okay, since the Korean War in 1950. Okay, so you see here, let me make this a little bit bigger. Yeah, okay. Okay, so you see every single one, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So 19 out of 60 years, that's a third, right? That's a lot. There's a lot of market downturns in here, right? And they go from minus 2.8 to, minus 56 when I said 2009. And then, so there's a lot here, okay? And also, it shows you the months to recover. So the worst case scenario was 2000, what is that? 2002. Yeah. So 55 months. What is that? Math is off this morning, so
1974, if you look up there, 1974 is 67 months.
yeah,
years.
correct. Right. So that's what I was saying. Like 4 or 5. I think in the worst case scenario is 4 or 5 years. They say over here it says on an average. I don't know how relevant an average is, to be quite honest. But so 15 months, that's about just under a year and a half. I'd say usually a market correction, you're looking between 1 and 3 years is I think reasonable to understand. But take a look, after these market declines, the average market decline is about 22% or 23%. A year later, you're 30% up from that point and 45% up 2 years later. So these are all averages, of course, but it hopefully gives you a little bit of peace of mind that they always say this time is different. It's never different. There's different consequences, but we go down, we come back up. We go down, we come back up. And if you've planned properly, you've been able to not get rid of the downturns, but mitigate them, especially for the times where you need money. That's really the most important. At the end of the day, what's investing is, I'm going to need money. How much can I make over that time period? Okay, so moving on. Those were more stock markets. Now let's take a look at bond markets. Once again, for those who say it's never happened before, we've had the worst bond market ever. Yes, I agree. But I always like to take a look at in the past and when we've had similar situations. The first, we basically had 3 in succession. One was in the late 60s to beginning of 70s. One was mid 70s, and then the other one was early 80s. So that was a little bit like the 2000s. That was a tough decade for everybody, right? So what you'll see is you had really high inflation at 3 points. And you see that bonds, like for example, the bonds didn't do very well. But you might be telling me, Jonathan, like last year bonds did -12 or -13. It's nowhere near. So how come they had high inflation, but the bonds didn't go down as much? The bonds did go down as much. So what happened here is, right now, I don't know, maybe somebody can tell me, inflation in the States was at 6%. It was closer to 7 or 8 in November. What are the interest rates today? Like overall interest rates? Does anybody know?
Like to borrow?
To borrow?
No, not to borrow, not more. But you know what? You could say mortgage rates. But let's say you go to a bank and they say savings account will pay you X amount, or a GIC or something. If you go out today and you're trying to get an interest rate as an investor, do you know how much that it's paying?
You can get up to 5% depending on who you invest with or how long.
Perfect, exactly. So 5%. Inflation at one point was 10%, and interest rates were 5%. So in the 60s and 70s, it was the opposite. Inflation was really high, but interest rates were even higher. Okay, I remember my dad telling me this mortgage rate was, at 20% or something at some point, just under 20%. So here's what I'm trying to say. A 30-year bond, okay, it might look like, okay, how did bonds make money that year? Well, you started off the year with a 15% return, and you ended off with 2, meaning what? Meaning that you lost 13%. And the same thing happened in 1980. Same thing happened in 1969. Okay. What I want to highlight for you, however, is that, following those bad inflationary years, and then you see inflation goes down substantially in the next 2 years. Look at how much bonds returned: 16 and 17 and 10, so 27% basically over 2 years. Here, just under 20% over 2 years. Here was a little bit of a different example, but almost 40%. I'm not saying expect a 40% rise in bonds, but we've taken the pain already in bonds, meaning they've gone down 12. I would expect if we go into a recession, whenever there's a recession, interest rates come down. Why? Because governments are trying to make it easier on people to borrow so that they can they can spend for their groceries, and then they can spend for other things. It can turn around very, very quickly. It can go from prices are going up to prices are coming down because people are losing their jobs or whatnot. So that being said, I would expect that bonds do quite well in the next 2 years. Already, if you can get 5% at the bank, like you mentioned, most bonds are paying that as well. They're around 5%. Some are even higher, of course, depending on how long you want to go. Okay. So this is just to give you a little bit of history in the past. Okay. So here's the example that I wanted to show you. This is just a normal bond portfolio that we have. The product doesn't really matter. Okay. But I wanted to give you an example of what to expect. Oh, sorry, I forgot to change this here. So we have a yield to maturity is basically when you go to a bank, this is the interest rate they'll pay you. So this fund specifically, it's a very secure fund. It only buys Government of Canada's. So it's going to pay you 4.6. The average bond in the portfolio is going to have a 7-year maturity, meaning you put in the money now, and it works a little bit different with portfolios, but bonds is you put in the money now and you get it back in 7 years. Well, look, there's a little formula that shows that the return that you're going to get on your bonds is based on how much the interest you're getting. So this would be like if you go to the bank, you get 4.6. However, if interest rates go down at the bank, meaning if the Government of Canada interest rates go down, the bank's not paying you anymore. They're going to pay you 4.6 and that's it. Okay. If you hold the actual bond, you actually have a price appreciation. And once again, I apologize. I should have changed this. I didn't have a chance to, but it's actually, let me do it. I can do it now. 4.6 plus 7.4. 7.4. So this would come to 12%. So if interest rates go down by 1% this year, which if inflation comes down very quickly, as it has been, by the end of the year, and if there's a recession, I think this is very likely, the bonds will make 12%. $14.8. And then 19.4. So 19.4 if interest rates go down by 2, and you say, okay, Jonathan, what case would that happen? Like, how can interest rates go down by 2%? I said it's very possible. It depends how bad the recession is the answer. Because we went from essentially 0% interest rates, and when I say 0%, doesn't mean you could have gone to the bank and got 0%. It literally means what the bank rate is, went from 0% to 4. So even if we don't go back to 0, which I think is highly unlikely to go back to 0, but even if we go down by half because there's a recession, bonds will be up 20%. Okay, so that's pretty much it. That's what I wanted to talk to you about. We talked a little bit about more your portfolio and how it pertains to you and stock and bond markets and what history has told us. So before I conclude, I just wanted to take some time and listen to some of your questions, concerns. Ask me anything you'd like.
And I just wanted to break in here quickly and say that this went a little longer than I had initially anticipated. So if you have to leave at 1 o'clock, feel free. We'll keep this going for a few minutes beyond 1 o'clock if there's questions and we need to. But go ahead and ask any questions that are burning in your mind right now.
Super.
Sandra, you're on mute. I don't know if you'd like to ask any questions.
Looking at a lot of your charts and say you start at 10,000 and it will grow to a couple $1 million. Is that just based on that initial 10, or am I still funneling 5,000 a month or something into there, and that's how it grows?
So this was the example you're referring to, the
Oh, yeah, your
200K.
200,000.
Yeah, so that is just based on the initial 200,000. I am not adding anything to it afterwards. There's no
Okay.
other savings. So
Yeah,
that obviously it makes a big difference.
Sandra, you missed the first couple of minutes too. This has been recorded, so I'll send you a link to the full presentation too, so you can get the first couple of minutes.
Okay, and then if you were to go to the bank for a bond and get the 4.6, how do you get the other one where you would do better?
You're referring to this, right?
Yeah.
Yeah. So what happens is when you go to the bank and either a savings account or a GIC, right? It's the bank that pays you that, and then they take the money and they go invest. Okay. This that I'm showing you here is if you were to purchase this, it's actually a fund. It's just a Canadian core bond fund. Canada Life has one. Other companies have one. They're all very similar. Basically, what you're doing is you're buying the bond yourself, right? So when you go to the bank, they pay you the interest rate. They give you your money back after 3-4 years, whatever it is. You're basically buying it yourself and you're benefiting from interest rates going down. So that's the big difference. If you just go to the bank, you get the interest rate and nothing else. If you buy the bond for yourself or you buy the bond fund for yourself, you get the appreciation when interest rates come down.
Do they let you do that in a TSFA as well?
Correct, yes, any account.
Okay. Thank you. I do have to run.
All right, thanks, Sandra.
All right, so just to conclude, basically, you should choose your investment based on your income needs, right? You should build it. You should not do, I'll choose my investments and we'll see what it does. It really is, what do I need? And let's fix the portfolio based on that. Diversification does reduce risk. We talked about, I think it's going to be a very good year for bonds this year. I'm not so sure how good of a year it's going to be for stocks. I was a little bit worried about stocks last year and bonds. So unfortunately, I was right. I don't like being right in those situations. I'd rather be wrong. But I was right that, in those situations, it's a little bit tough, but the diversification, and what I mean by diversification is buying stocks and bonds and Canadian stocks and different type of stocks as well. It really does make a big difference. Everything I just showed you about Canadian stocks doing well over 10 years, if you buy just energy stocks or you buy just technology stocks, that goes right out the window. Okay, you have to be able to diversify within different sectors, different industries as well. Selling out at the wrong time can definitely reduce your returns. So understanding what pot of money is allocated to what income is very important to understand. I think bonds are poised to have a good recovery this year. And I think if you're in a balanced mix, meaning, that 50-50 stock versus bond, I think the stock portion of the portfolio won't do as well, but the stock portion of the portfolio will do better near the end of the year, going into next year and the years after that. So I think that you'd do very well in a balanced mix, just in general, obviously exterior to your goals, but I think you do very well in a balanced mix over the next 2 years, 2 to 3 years. And that's it for me.
Thank you.
Thank you.
All right. Thank you very much, Jonathan, for coming and taking care of that for us. Oops, I just muted myself. There we go. I had mentioned in some of the emails that I was going to make an announcement about some other products and services that I'm going to be offering. We're over time and not a whole lot of people still here. So I will make that announcement another way at a later date. So that is it for us today. And I apologize again for going a little bit over time, but it was good information, and I really thank Jonathan for being here and providing that for us. So at that point, I'm gonna go ahead and stop the recording,